We'll be getting started in just a little bit here, YouTube homies. I will be streaming Flow live here on the channel. We'll have Market Tide looking at net options premiums for all of the stock market. We'll have the SPY chart up during the whole ordeal. And then over here, you've got market maker exposures via gamma exposure. This is called the Periscope tool. There's a good video here on the channel about this tool. Definitely check it out. I personally use this for scalping. We'll get going here in a moment.
Just waiting on Jam, but we'll have Nicholas start us off with introductions.
Welcome everybody, as always, this time to our October FOMC panel for 2025. The economy continues to serve some contradictions going on here. Growth hasn't really collapsed per se, yet inflation continues its refusal to bow down and bow out of the fray. The labor market's showing patches of fatigue as well, which we'll definitely touch on in more depth later on in the panel. All this while the government shutdown is delaying key data releases, leaving the Fed to fly partially blind here. There's also still the global friction persistence from trade tensions to energy supply jitters. And like I said, we're going to touch on all of these topics today. We're going to dive right in to some introductions and get this thing started. So starting us off with our panel of experts today, welcoming back our go-to Fed guy, Joseph Wang. You know we love having him here. Headed the Fed's Open Markets Desk. Has a great introductory book I like to plug on every single one about central banking called Central Banking 101. He's the CIO at Monetary Macro and a staple of our FOMC panels. Welcome back, Joseph. Looks like nobody can hear anybody on the Twitter space.
I can hear you, Nicholas.
Oh, I hear Johnny, but I wasn't able to hear Joseph or Martin.
Looks like Joseph is muted.
Hi, it seems like we're having some technical difficulties here. Apologies about that. We'll just make sure everyone has muted their mic. Sorry about that.
Yeah, no worries. I did see Joseph and Martin both unmute, but no sound coming
I'm here.
from
Can
them.
you hear me?
I hear Martin as well.
Okay.
Joseph and Last Bear, can you do a quick mic check? Sounds like Whale can't hear any of us.
Hey guys, can you hear me?
Yep, you sound great as well. Joseph, one more try. Maybe Joseph isn't able to hear me. I will continue going through these introductions while we try to figure out those tech issues. Up next, since he can hear me, we've got our man, the Last Bear Standing, another long-standing friend of the spaces, an expert on markets, and he also writes a lot about monetary policy and individual names that he's watching and tracking in his weekly Substack. If you're not subscribed to that, go do that. A lot of good information there. Welcome back, as always, Last Bear.
Hey guys, thanks for having me. Hopefully we resolve some of these issues, but we got a fun FOMC ahead of us with some unusual wrinkles this month with the shutdown and QT and rate cuts, so it should be a fun one.
I'm really looking forward to this one too. I think we're going to have a little bit of spice going on in our discussions today. Next, we've got Martin Pelletier. He is the portfolio manager at Trivest Wealth Council, an often columnist for the Financial Post, an avid skier, as I always like to point out because I can barely walk down my stairs these days. Welcome back, Martin. I'm excited for this one.
Hey, thanks for having me. Just give you a little bit of a heads up that Prime Minister Carney asked me not to talk about Ronald Reagan and tariffs, okay?
Now we're going to be robbed from it because the prime minister said so. Don't do that to me, Martin. Up next, we've got our man, Johnny Matthews, Mr. Super Macro himself, another homie that's a friend of these spaces. I love having him on here when he's able to. Over 25 years of experience investing and trading under his belt, with about half of that time spent with a macroeconomic focus. He currently also has a site, blog, and service, Super Macro, constantly publishing in-depth market analysis and economic developments that affect the macro landscape. Welcome back, Johnny. Great to have you as always, and I'm glad we can hear you.
Thank you, Nicholas. It's great to be back on the show, and I agree. I think this is an interesting Fed meeting. We know what the outcome will be, but I think there's a very divided committee now. So the statement and Powell's press conference will certainly be interesting.
And it actually kind of looks like the market's holding its breath this time too this morning beforehand. We're just kind of chopping in a little range here within the gamma exposure cone for XPX for anybody interested in that nerdy stuff. Next, we've got our man Jem Carson, a leading volatility expert that I always love having on here. Founder of Kai Volatility, has a lot of stuff going on over there at Kai that I am not entirely up to date on. I know you guys launched a bunch of new shit, Jem. What have you guys got going on? And as always, welcome back, man.
Million plates spinning over here. A lot of great things, but yeah, everything from broader different asset allocation models that we're running on an investment advisory side to upcoming ETF, which I cannot talk about yet, but will be very exciting. So a lot of wonderful things. Today, the Fed is increasingly becoming a beholden political entity. You can argue it always has been. But I think the pressures that are being placed on it are making the outcomes much less about will they, won't they, as a function of what they should or shouldn't do. And so that'll be interesting to talk about as a I think it changes the conversations around it. But I think there's a big set of ramifications of that today, which we'll probably get into. But excited to be here as always, and it's been a while, so this will be fun.
I am roaring and rearing and ready to go, Jem. Thanks for coming. Joseph, I am begging and praying the Twitter gods that you can hear me and I can hear you. Uh-oh. All right, so what I'm going to do here is I'm going to go ahead and jump right into things. I'll shoot Joseph a DM to see if we can't get that figured out. But to start us off here, the September CPI rose 3% year over year, with core inflation moderating only slightly and rent inflation showing its smallest gain since I think all the way back in January of 2021. Now, everyone listening probably noticed that I said September CPI there, not October, even though we're used to seeing CPI come in before the Fed decision, before the FOMC meeting. The federal government, as you all know, has been shut down since the first of the month, which has halted major data releases from pretty much every major data agency like the Bureau of Labor Statistics, the Bureau of Economic Analysis, kind of leaving policymakers and markets without key economic indicators. Now, with that in mind, I'm curious, how is the Fed really navigating decisions without these entities? I know in some cases there are private sector proxies like ADP jobs, ISM surveys, those exist, but do those really substitute and fill in the gaps needed to dissolve any potential policy errors? Can we really trust that today's Fed decisions reflect the reality of U.S. conditions without these entities giving us the data? Let's start off here with Martin, if you don't mind.
Yeah, you betcha. I think there's enough data to work around what's missing. If you take a look at, and we talked about this before, you have a small percentage of the population driving consumption, and you've got a lot of consumers that are struggling out there. And the AI capex boom is not working its way into Main Street. What really amounts, if you're looking at it in the AI world, is that only 1% of the population is benefiting from what we're seeing here, and the bottom population is struggling. You had UPS disclose that the company's eliminating 35,000 jobs. above the 20,000 that it was expecting previously. Amazon's cutting jobs. GM has laid off some employees. Target's doing some layoffs. And then of the overall numbers, if you take AI out of the equation, you have GDP that would be fairly flat. You got California and New York that's carrying the entire economy on its backs. And so you have this widening gap between the wealthier and the poor. And so the inflationary pressures from wage inflation and that sort of thing would be not as strong as where it has been historically. And the tariffs haven't been passed along to, I'm going to talk tariffs, but not from a Canadian perspective, but from an investor perspective, that haven't been passed along to the consumer as of yet. And we're working its way through trade agreements with only 3 countries, I believe, left to finalize some sort of agreement, and Canada being one of them.
Thank you, Johnny. Do you have anything to add to that? I'm especially curious about the point of view from the BOE, if applicable here, because I know that they released a statement pretty recently, kind of focusing on macro some, and I'm curious what you're feeling on that front, Johnny.
Well, I think the Bank of England has very different challenges to the Fed. In the UK, a lot of the inflation was driven by government policy, minimum wage hike and council tax and utility bill increases in April that really pushed up the CPI. So there was a lot of policy driven inflation that's got into the system, and we have a very high inflation rate, 3.8%. And so the BOE is taking quite a cautious approach to cutting. But I want to come back to the US. It's a very different situation. And I'm not so sure the US is really struggling as that much. I mean, if you look at, first of all, second quarter GDP growth, 3.8%. Q3 looks like it's going to be on track for a similar pace of growth when we eventually get the data. Prior to the government shutdown, we had 2 very strong months of consumption growth in July and August. Strong enough that the Atlanta Fed was projecting a consumption growth of over 3% in Q3. So from that perspective, I think consumption is the main driver of economic growth in the US, and that is still pretty strong. Investment also plays a large part, and that certainly is going gangbusters with all the investment in AI infrastructure. And when it comes to the labor market, I think when you've got growth running at 3% or so, it would be a very, very strange situation if labor demand were to fall off a cliff. Now, as you rightly said, we have alternative indications of the strength of the labor market. We've got weekly jobless claims. They're not published, but the states are still publishing statewide jobless claims, and you can add them up and make the seasonal adjustment and get a very, very good idea of where the weekly official jobless claim, weekly initial jobless claims should be, and they are still running very, very low. So layoffs are running at a historically low level. We know that hiring has slowed, but it was really pumped up after the pandemic. When the economy opened, there was a massive surge in hiring, and it has been normalizing ever since. And if you look at the JOLTS data, the job openings data for the last year, it's kind of been flatlining. It's been up and down, zigzagging along a horizontal trend. And job openings at the last print were still higher than just prior to the pandemic. So in my view, labor demand has cooled, but it hasn't collapsed. It really hasn't collapsed. And when it comes to the other side of the Fed's mandate, the inflation, I agree, we are missing quite a bit of data. And there are different dynamics taking place. Obviously, the tariffs are a one-time price level adjustment, but that will take some time to feed through the system. Going in the opposite direction, rental growth is still slowing. I think it was an exceptionally low print that we had in September that, probably won't be repeated in October if we do get the data. But either way, I think as far as the Fed's concerned, the Fed is concerned about the slowdown in job growth, and the Fed is going to cut and probably cut again in December. But I don't think that the cuts that are priced in by the market for next year will materialize. I think we'll get stronger signs of labor demand over the next few months, and inflation is going to hang around at about 3%. And I think the market has really over-egged this.
So just as like a little follow-up there, Johnny, and then of course, as always, anyone in the panel, feel free to chime in. Just on that topic there of the labor market, layoffs, et cetera, we have seen in the last month or two a lot of pretty major companies kind of not necessarily hinting, so in a couple of cases it's pretty explicit, at some pretty major layoffs or restructuring going on. I know Amazon specifically just said something like 75% of operations to be automated is their goal, and they're also laying off. I think they confirmed. They initially said around 30,000, but they confirmed at least 14,000 corporate positions. Is this something that we should be concerned about at all, or is this just kind of like a cyclical thing for these large corporations?
I don't think you should get too focused on these announcements. Challenger Gray and Christmas, it's an outplacement agency. They publish a monthly count of layoff announcements. And what typically happens is companies announce so many layoffs and they never actually follow through with that number of layoffs. And to put the numbers that you've mentioned into perspective, every month about 5 million people leave their jobs, and a bit more than 5 million go to new jobs. Some of those are layoffs. Most of those are voluntary changes, but the labor market is still very, very dynamic. So off the top of my head, I don't remember the typical number of layoffs that you get in any 1 month. But, when you talk of a large company making a high profile announcement of job reductions, say numbers like 30,000, it's going to be spread out probably over the next year. They probably won't actually go ahead with that many layoffs, and I think it's trivial in the scheme of things. Really, tens of thousands when you're talking of a total employment of something like 160 million. So it's always important to keep a perspective. They may be very high profile companies and they may look like big numbers, but in the scheme of things, they're not that big.
Thank you, Johnny. Does anybody have any agreement or disagreement there? Feel free.
Hi, guys. Can you guys hear me?
Yeah, Joseph,
Oh,
baby!
yes.
Hey, Zach, awesome.
Let's go!
Well, first off, thanks so much for having me. And that was a great explanation by Johnny. One thing I'll also add is that something interesting we found out from Chair Powell last week is that according to the Fed's internal estimates, the break-even job creation number each month, it's like 0 to 50,000. So that's a pretty low number. Now that they're basically saying that even if we made 0 jobs a month, that wouldn't be too awful. And that, of course, is because they think that population growth has slowed down a lot. And so I agree with Johnny that maybe the rate cuts next year will not. Market might be a bit more aggressive to that since inflation still is above target and has been for quite a long time, as our friend Bob would say.
Thank you, Joseph. Thank the Twitter gods. We can hear you now. Your input's going to be great for a lot of these questions I got coming up. So I'll be picking on you a little bit here soon, Joseph. So just kind of back onto inflation a little bit here. I want to touch on shelter and rent. Now, shelter and rent inflation is still pretty sticky. It's one of those ones that's really kind of clinging to and not giving in much space at all as time goes on here. But it does appear to be moderating at least a little bit. And so I'm curious with things like housing, which is very big, buzzworthy word, and yeah, there are plenty of issues, and we also know that some of these things are based on regions within the US as well. Some of like the coastal cities have significantly inflated costs of housing, and other places the availability is not there. But my question here is, are these trends finally signaling genuine relief in core inflation via this slight moderation we're seeing in pricing of housing? Or is it merely masking persistent price pressures elsewhere? Last Bear, do you want to take a stab at that bad boy?
Yeah, sure. So I do think that there have been some recent indicators that have shown rent prices starting to tick down, at least in terms of the growth rate, down from if you looked at the last decade, it was probably around 3% on average, and it has kind of went from a very high number in the early part of the pandemic or 2022 timeframe down to something like 3%. Now it looks like it's coming down to something more like 1%, so well below sort of the average of the prior year. Granted, that's after a period of pretty substantial inflation nationwide. But I do think that there are elements of housing absorption. So basically, there was a ton of multifamily in particular starts that happened, and sort of that boom in rent prices a couple years ago that are now hitting the market. I think the market is at first it was pretty good at digesting that new supply, but I think that that is starting to fade a little bit, especially when you take into account the population dynamics that some folks were referring to earlier, where basically population growth over the past couple of years was highly driven by immigration, and that's obviously slowed to almost a total halt in a pretty short period of time. At the same time that you have a lot of new units come on. Now, at the same time, renting still is substantially cheaper than buying with financing with a mortgage, and so there's a pretty massive gap if you're thinking about what's the price to own versus price to rent. And if you were to consider that maybe those should converge somewhere in the middle, then you could argue that there's still plenty of room for maybe housing prices to come down and rent prices to maybe continue to creep up. And obviously, how that's reflected in CPI would sort of be somewhat of an offsetting factor. But I do think that there are some more real time signs that there is cooling in rents. Given how big of a portion of the CPI or PCE price index that is meaningful to the overall index level. And at the same time, obviously, there's still the sort of the lagging effects that everyone talks about, which is sort of a methodology issue, but that we're just sort of continuing to, in some ways, catch up to the old numbers by having higher than real time numbers, but that continues to be sort of a direction and a push in the downward direction. So I do think that that's a major component of CPI, but it's also one that's probably pretty well sort of understood or forecast. I think that there's also it's a little bit more uncertainty around how things like the goods going from a negative CPI to inflecting back to a positive. How much of that is tariff related? How much of that is just sort of a reversion to the mean? How other services are going to react going forward. Obviously, the reality is the Fed has been nowhere near the target for 4 or 5 years, and yet they're cutting into it. So the other dynamic is just what their what their actual target is and what their tolerance is for being above it seems to be pretty substantial. So I don't think that changes the near term of cuts for the next couple months, but we'll see if more persistent inflation changes that next year.
I'll jump in here. I think that rents are going to continue to drop. We're seeing that more pronounced here in Canada. For example, on the oversupply of housing and condos in Toronto, the replacement value is $1,200 a foot, and stuff's being sold off market without impacting the price at $690, $675 a foot. So there's a material drop there, but we're not seeing that being reflected in prices. In the US, you look at mortgage rates, they've fallen from, at the 2023 peak of 7.8% down to 6.2%. But housing prices are still up considerably. I think I read somewhere around 40 to 50% since 2020. And so mortgage payments as a share of income are above 30% compared to 20% pre-pandemic. We won't talk about Canada because it's a lot worse. It's like closer to 40%. If you look at the inventory lockout effect, you've got 80% of homeowners hold mortgages at least 100 basis points below current rates. So that's discouraging some sales and freezing supply, and so that's going to keep some of the prices higher. And so rents will continue to drop, I think, across the board in the U.S. and certainly very much in Canada.
I'll actually hop in here and say something. I think the one thing we're really not highlighting is here we're talking about kind of real estate and these markets kind of a monolith. And I think more than ever, we're really, really experiencing massive bifurcation in the U.S. and global economy, not just rich versus poor, which is part of it, but really, it's almost segmented into different corners of the U.S. even, right? Like real estate is doing incredibly poorly in the some of the corners that were dependent on international demand. Think of it as the Pacific Northwest and California and Florida, right? There's some other aspects that are hitting things there, natural disasters, et cetera, as well. But when you go back into kind of the middle of America and certain parts of America that have not seen some of the growth over the last several decades, you're seeing a lot of strength actually. So you're actually seeing a real interesting bifurcation there. Some of that is really this bifurcation between, the slowdown that we're seeing in the economy is really a function of the bottom 50% and the demand there. It's also centered around a younger cohort, which we've seen happening for some time. The frustrations of those groups, by the way, which has been causing a lot of political upheaval, are not. Whereas that we were sending money to those people, now we've really reversed that in the last year or so. And so there's some really interesting kind of dynamics at play. I think top 10% of all earners are now 50% of consumer spending. That's up from 35% just in the late 1990s. So this is a very different economy. The more the market goes up, that wealth effect is very real. That wealth effect is supporting higher home prices on the top end. Meanwhile, you're having credit issues and all kinds of a slowdown happening on the bottom. So it's really market by market, and it's really price by price. You're seeing a very, very bifurcated, different real estate market, and that really applies not just to real estate, but really broadly across the economy.
Thank you, Jem. And you bring up a good point as well in regards to just kind of general consumer resilience, I think. Credit delinquencies, for example, been rising significantly, everything from credit cards to mortgages. And Fitch actually just said that auto loan delinquencies have reached their highest level in 14 years, for example. So it's kind of telling there. But I guess in more of a broader scope, what does this tell us about consumer resilience? Is this like a passing phenomenon, or are we seeing hard evidence now that the wages versus inflation ratio is starting to kind of floor the consumer?
I think it's tied much more. I'll just answer that real quick before somebody else hops in, but much more tied to the market than ever. So I think everything is so levered to market action and liquidity now. But that's equally going to be the case to the downside. I mean, that's always, the market's always had a wealth effect. It's always been important. But the size and scale of liquidity created by the market now and the importance to it, to the consumption in the market, is just dramatically higher than it's ever been. And so I think, you can simultaneously, it's kind of hard to hold in your head, but see credit issues, see defaults in part of the market, while you could see simultaneous strength in another part. And that's kind of hard to hold in your head at the same time. But I think that is a bit of what we're seeing at this point.
Makes all the times that I tripped chewing and walking gum at the same time seem pretty trivial at this point, I would say. So I want to kind of just detract a little bit here back towards inflation, just kind of as a general overview, specifically on the tariff posturing. So the ongoing tariff posture and that recent data, mentioned earlier from September, kind of suggest that supply side inflation is still hanging out there and it's still a risk. Is such an issue as inflationary as some economists argue? And kind of tag along onto that, if tariff-driven costs do lift headline CPI alongside cooling demand, is there an argument to support further pauses at these meetings? Let's go Martin on this one.
Oh boy. I don't. Yeah, no kidding. That's probably a better one for some of the other panelists here. If you look at how much has been passed along to consumers, I think the St. Louis Fed said about 35% have been passed along so far, and that's expected to rise about 55%. And then roughly 2/3 are expected to hit consumers. So we haven't seen the impact yet. And so I think it's just a matter of time and data. And I do think it will impact the U.S. consumer. It has to. And the closer we get to getting away from this taco reference and seeing the reality of it, the greater the chance that this is finally going to get passed along to the consumer. And so the big question is how long will it stay, or how much is it going to be, and how long is it going to stay? And I think consumers, they don't give a shit about month over month or quarter over quarter. They're looking at their living expenses from 3-4 years ago, and they're like, everything's like 25% more expensive. You see pictures of people posting groceries online, and I'm probably one of them because my wife sent me to the store the other day and I was shocked. So I think that's the reference, and so there isn't the appetite for it. So that's the pushback against passing it along to the consumer. So we'll have to see. If it does, then it definitely will impact, and it will have a supply side inflation risk. Absolutely.
Anyone have anything to add to Martin's points there? Really good response, Martin. Thank you.
I do want to make a couple of points just to put things in perspective here. US consumption is 70% services and 30% goods. And about 20% of the goods that are consumed are imported. So that's really, you're down to about 6% of consumption. Now, Fed studies show that actually about 10 or 11% of total consumption is comprised of imported goods. So that's a relatively small proportion of the total consumption basket. So these tariffs, as painful as they are for some people on certain products, they're not having a massive impact on the overall price level. And I don't want to sound all sort of Marie Antoinette here, but for most of the most households, I doubt that these tariff hikes will have as big an impact as many people fear. I think the much more dramatic impact was the really sky high inflation that we had following the pandemic, that really pushed the consumer price index up a long way, and certainly it's not coming back down again. I actually am shocked when I do some grocery shopping in the US. Stuff is so expensive. It's quite staggering, and I know it's kind of like a regressive tax in that the lower income households spend more of their money on food and so on, and to the extent that that food is imported, it's going to hit them harder. But I think the tariff impact has probably been less dramatic than a lot of people expected. I think the average effective tariff rate that many economists are calculating at the moment is running at about 12 to 13%, lower than what the Yale Budget Labs expected, because either there's import substitution or the wholesaler, the distributors are absorbing the hit in their margins. But whatever the reason, we're not seeing such a massive impact from the tariffs so far. And I suspect, it will be a one-off hike in the price level that we'll get through this in about 6 months or so. By then, the whole of the pass-through should have taken place. And I suspect, the pain will be shared between the exporter, between the importer and the distributor, and the consumer. So it's not going to be a killer for the economy. Let's put it that way.
I do think there's some truth to that. I think the bigger issue is immigration. I think we've completely shut down the southern border. Our average annual immigration for the last 4 years was about 2.25 million new people coming to the United States. I think that is an incredible amount of this labor supply. It was about almost 2% of the labor supply per year. That stopping is a big deal. And, to the point that services are the bigger part of the economy, that is the supply of services. And I think that actually is a equal, actually much bigger effect probably going forward. And I think that's something that people aren't looking at it enough. We have on the tariffs also done a lot on the back end that doesn't get talked about to mute the effects of them. There have been a lot of exceptions. It's not just the public delays and this and that. But I do think that is something that's important. And the other part, that I think is, again, not talked about as much as it should be is the increased spending on military and global conflict. I think that was a huge part of the 70s inflation, Vietnam, and I think that's an increasing thing we're seeing consistently, even though we've pulled back on other fiscal spending on the big, beautiful bill. I would also expect that short-term effect will reverse as we head into the midterm next year, as it'll be hard to hold the line for Congress on spending as we move forward here. So some things to think about on the inflationary front that are above and beyond the headline tariff conversation that everybody's talking about. But I do think I agree with those points about tariffs.
I'd like to jump in, and I want to. I don't want to take over here from directing questions, but I'd love to hear Joseph's thoughts on what we just like. If you look at services, including shelter, it is 65 to 70% of CPI inflation, and you have a small percentage of the population driving like a vast majority of consumption, and housing remaining strong. But if you look at households and what they own as a percentage of their portfolios in equities, it's also quite high. And so if you have Joseph, do you think the Fed's looking at the market where it is right now and the highs? And we're going to obviously talk about the shift from tightening into easing, given what's happening in the repo market. But what are your thoughts if the Fed, are they looking at the market continue to move higher, and is that going to continue to drive services inflation?
So a lot of us, a lot of us make our living off the market, and we are watching this every day. But so we're focused on the market going higher and higher, and then we're looking at the Fed cutting and thinking that's really weird. But from the Fed's perspective, that's not really their focus. In the past, recently, Chair Powell has made comments that the market seems to be a bit overvalued. But from their perspective, first principles, it's full employment and price stability. And if you're looking at how they try to impact the economy through interest rates, it's through interest rate sensitive sectors like housing, where people buy homes on a levered basis. So financing is important, and autos to some extent as well. Now, if you look at housing, new construction homes, permits and so forth, housing has basically been in kind of a recession for the past couple of years. Home builders are able to sell homes because they're buying down rates, but that really has been slowing down a lot. So from their perspective, if they're more worried about labor, then you have to cut rates to try to help the real economy. And yes, maybe that makes financial assets go to the moon, but that's not like that makes people happy, right? That's you shouldn't just not help the sector of the economy that's actually tied to your mandate just because financial assets go even higher. But with respect to inflation, something else to keep in mind is that when the Fed is they're looking at tariff inflation, all that, they know that it's a one-time change in the price level, and according to orthodox central banking, they're supposed to look through it. But they can do that as long as inflation expectations are stable, and according to the indicators that they're looking at, it's still stable. So they're not too worried about tariff inflation at the moment. And as many people have noted, you don't really see that much. And it's looking like it's playing out really just like it played out in 2018 and 2019, whereas the increases in tariffs were largely gobbled up by the distributors in the form of lower profit margins. We hear a lot of anecdotes that people would like to pass those costs on, but also hear anecdotes that consumers are pushing back. So it doesn't seem like, at least at the moment, they have that ability to pass it on.
I actually tend to think that that they're completely looking at markets, and they'll never say that publicly. The rhetoric will never say that they're managing markets, but there's no denying that the greatest driver of liquidity on the planet is, and it's always been important, but by far the greatest driver of liquidity on the planet is not the Federal Reserve. It's not the U.S. Treasury. It's financial markets themselves. I mean, we have $500 trillion of long assets in the world now, and now 10% of the top 10% of the population in terms of wealth drives 50% of consumption. I don't think we can say, with the market with $500 trillion of assets up 20% for the year, that $50 trillion, that $100 trillion of new collateral that gets fed into the system is not something that the Fed or the Treasury are looking at. I think Besant et al. In particular are incredibly focused on that. This has been a very, I think it's hard to deny that this hasn't been a very engineered liquidity push in markets to drive them higher. And I think the explicit reason is to support the economy in the context of tariffs, immigration policy, a lot of other things. And I think ultimately, yes, it'll support the part of the economy, the top 10%, and there'll be some trickle down in the short term. But the question is will that lead to inflation or not, and how does that look when it eventually comes under the weight of its own? How high will it go before at some point, right, some type of reversal? You'd think there'd be some gravity at some point, not. So that's the problem with this whole system, and I think they're very aware of it. I think the Fed is trying to figure out how to manage that circumstance, but I think they're beholden to the administration at this point, clearly, and I think that's the bigger issue. So I think it'd be silly to not look at their effects on the market and the market's effects net on liquidity in the economy at this point.
Beautiful discussion there. I don't think there's really anything I could add to any of that. And we actually chipped right through a couple of questions I had. So I do want to just kind of touch real quick on one more inflation specific question, and then I'm going to move us back over toward that discussion on the labor market, labor slack, as it were. But first, we've brought this up a few times before in the past, and this is just about, once again, that good old-fashioned 2% inflation target that we've discussed. And analysts have argued in some ways that the Fed has already, quote, won the fight on inflation because long-term inflation expectations have remained anchored throughout pretty much this whole ordeal, at minimum the last couple of years now. Now, if inflation readings do continue around that 3% currently, or even start slipping upward again, as some are concerned happening with the tariff discussion amongst other consumer issues that are popping up, how are we really feeling about the Fed's credibility on that long-standing 2% target that I know has been harped on again and again? But I wonder, is that number even something worth discussing, or are we going to turn into Clark Gable? Frankly, my dear, I don't give a damn. Last Bear, what are your thoughts here?
I think it's probably kind of what you said. I mean, if there was a strong desire to that you needed to literally hit the 2% in order to justify cutting, that's what would have happened. And clearly, there's easing, both the signaling of easing, which I think started I would argue back in 2022, once you started to see inflation hit its peak and start to come down off, granted it was still 8%, but it had come down from 9%. You started to see in the dot plots that the expectation was 3 years out, rates were going to start to come down. And so you saw, the market, that's when the stock market bottomed, that's when financial conditions started opening up again. And so there's, the loosening has been happening for quite some time. And obviously, even at this point now, we haven't gotten really close to hitting that target. And so it's clearly a decision of, run it hot, so to speak. I think even, Besson has basically said that, and those words are similar recently, where we're going to grow our way out of it instead of, trying to really clamp down on it. Now, granted, we had conditions that were very disinflationary. Both you had a big reset in goods demand in the sort of 2022, 2023 timeframe off of, an extraordinarily elevated base. You had energy prices, oil go from the 120 to 60. You had a lot of positive factors that led to the disinflation that we saw. Now, going forward, w- those levers aren't necessarily there. Potentially, in some ways, housing and the shelter, it's probably the biggest component that's still left to, potentially come. But we already went through a period that should have seen pretty rapid disinflation, and it did, but it brought it from 9% to 3%. So clearly the Fed's actions, historically over the past several years and their indication about what they plan to do today and over the coming months indicate that the 2% is not something that really that is going to guide their decision, other than being able to sort of credibly continue to say, or until they lose credibility, I guess. So it's clear that it's not a target that needs to be achieved.
So would you say, just as like a quick little follow-up, would you agree with what some economists have said in that 3% has become the new percent, and that's kind of why some pundits are pushing that narrative that the fight of inflation is over and we've won?
Yeah, I think that's what the Fed has signaled in their actions, if not their, while not their words, in their actions.
Thank you,
Well,
Last
hey,
Bear. Yeah, go ahead, Martin.
bond markets are telling you it's not over. Bond markets are pushing back. You've seen 3 cuts. You've seen a number of cuts here this year, and bond markets are still, bond yields are still staying high. So I mean, have they? We're talking about if they cut 25 here, and the bond markets say don't give a shit.
So
I also think there's
actually,
a major.
Jem, go ahead.
Sorry, I was also going to say there's also a major. There's been a departure. If you look at the long bond in the United States versus global, you're also seeing kind of different directions, and I think that tells the story of what's happening in the U.S. liquidity wise. There's a concerted effort to, provide liquidity to the long end of the curve here in the U.S. and when you're not seeing that, bonds are staying higher, like Martin mentioned. So I do think that some of this is the canary in the coal mine is not is that these things aren't really being able to be moved internationally, and we can manage them, but I don't think the inflation expectations are nearly as low as markets might be saying. Go ahead.
I want to make a couple of points. First of all, these elevated inflation readings are not just in the US. The UK is close to 4%. Australia this morning printed 3.5%. Sweden's above 3%. Japan's close to 3%. Canada, Germany 2.5%. So the 2% target is not being achieved across a lot of the G10 countries. And when it comes to the long end of the curve, I think I'm actually surprised at how relaxed investors at the long end have been. And in fact, the very long end of the Treasury curve, the 30 has been outperforming the likes of Japan and the UK and Europe recently. But I think if you look at them over the last couple of years, the ultra long bonds, they are really performing badly, and pension demand is really waning very, very fast. There's pension reform taking place in Europe that's going to reduce the demand for really ultra long dated government bonds. And I think at the moment, even with the yields where they are, I think there is a risk that that long end of the curve becomes unhinged, because I think it's becoming increasingly evident that 3% really is the new target. It's no longer 2%. 3% is good enough. And certainly, and I've said this for a long time, the Fed is really not going to sacrifice the labor market for the sake of driving inflation all the way down to 2%. The Fed, if they wanted to, could put the economy into a recession and we get inflation down to 2%. They're not going to do that if they can possibly help it, which is why we're in the situation we are in today, where 3% is okay, as long as the economy keeps growing and the labor market stabilizes.
I think the elephant in the room that we have yet to discuss, which was probably the most important thing to discuss, is the forced resignation of Adriana Kugler, the attempted firing of Cook, the projected takeover of the Fed, I think eventual takeover of the Fed. Even if they don't have complete control, the administration has projected, which is just as important that they do, to markets. I think that's played a huge role in the market reaction at the long end of the curve. I think the other major important part is, you can look at the numbers and say, well, they don't have complete control yet. They have, 3 out of 7 and maybe 3.5, depending on what happens here with Cook. But what they've projected also to the governors underneath the hood is that they are willing to go to any means necessary to extract the policy that they want. And you can't help but think that politically, that is going to play a role in the decisions of the Fed governors. And as we all know, in May of next year, which is not that far away at this point, Powell is highly likely to not have his job, and the leadership is also to change. So I think that is the most important thing going on. We can talk, on top of that, what seems like a concerted, effort to not, release the numbers or to kind of run the numbers that they want the market to see, creates a very different situation for the Fed. This is not the Fed of 6 months ago, a year ago. They are not as independent. And importantly, we know from history, Arthur Burns is a cautionary tale. The firing of William McChesney Martin in 70, 71. And then the lowering in the face of sticky inflation, not too dissimilar than we see now. The lowering of interest rates aggressively by Arthur Burns. He lowered interest rates from 9% all the way down to 3% into 71. 6% decrease drove 3% from 3% inflation all the way up to 12%. And so I think the administration, importantly, not which by extension includes the Fed, is signaling and very clearly, if not explicitly, very close to that they are really going to run a debasement program. They're going to choose in a stagflationary environment the economy over inflation. And I think to everybody else's point, the market is telling you that underneath the hood. They're trying to, at the same time, manage the pricing here in the U.S. of the long end of the curve and those expectations. From sheer force of supply and demand, whether it's changing the duration on the Treasury side or through the Federal Reserve. But at some point, that is going to be very hard to control. If you get negative interest rates at the back of the curve, that will be a self-fulfilling prophecy. So I think that's the most important thing that we haven't discussed. We can talk about will the Fed, won't the Fed. I don't think it's about inflation or growth. Really, it's not a decision. It is about policy and a projected policy and desire by the administration.
Thank you all. A lot of great points there. I want to hark back here to something someone mentioned earlier on in that discussion about the treasuries. It's a bit of an aside here, but Martin, you had an absolute banger of a thread on Twitter covering the issuance of T-bills by the U.S. government and some of the concepts around QT, quantitative tightening. If JP Morgan's comment last week that the Fed will end QT this week What exactly does that mean if true, and what connotations will that carry? Is it a sign of, hey, we're good to go, or a little bit more complex than that?
And I'm gonna thank you so much. I'm gonna defer. I'm gonna get Joseph's thoughts on this because his Substack was the catalyst for me going down that rabbit hole and taking a look at the repo market. The reverse repo has been drained. That's done. MBS is not going to move, and then you've got the repo market that with repo rates rising. And then who's going to end up in the end having to buy all of these U.S. Treasuries because the Trump government is spending like a banshee and hasn't curtailed any of that, and they're going to have to pay for it. And how are they going to do it if public markets aren't going to do it for them? Is it the Fed? Are they going to start stepping in and buying treasuries? And this is, I think. I'd love to get Joseph's thoughts on and hand off the baton to what he thinks.
That's a really good point, Martin. Joseph, it was the October 27th issue, I think, that Martin's referring to. You broke down the Fed's focus on repo rates, and at one point noting that although the available amount of repo financing is, lack of a better word, enormous, it's still not enough to keep up with demand. So yeah, Joseph, definitely would love to hear from you on that.
Well, first off, that was a great Twitter thread by Martin. So I think there's some discussion that one of the big things that could happen today would be the end of quantitative tightening. And if not today, it'd probably be the next meeting. The reason for that is that...
real quick, Joseph, it sounds like you're getting some clipping here and there. Can you just keep that mic right close to your mouth? I think it's giving a little distance feedback.
Okay, is this better?
Yep, that's perfect.
Okay, so one thing to note is that one of the big things that could happen today is that today could be the end of quantitative tightening. And if not today, maybe the next meeting. The reason being, as Martin mentioned, is that there are signs that maybe the Fed might be going too far and shrinking its balance sheet. So one of the things that the Fed is trying to do is to make sure that there's enough liquidity in the financial system, just enough so that the banking system can function. It doesn't really know how much that is. So the way that they go about doing this is to look at market-based signals. And one of them they look at is repo rates. So as Martin mentioned, we had a lot of money in the reverse repo facility. It's like a repository for excess money, excess cash in the financial system. That's been drained to zero. And we see repo rates basically trading notably higher now above interest on reserves. And that scares the Fed a little bit because in 2019, that market went totally out of control and just totally surged and forced them to come back into the market. So if that's the case, something that they're worrying about, they could stop QT and maybe shortly after begin to add more liquidity into the financial system by buying treasury bills, expanding their balance sheet. So that's something to look out for this meeting. But I think the even bigger problem that we should look at going forward on the Fed is what they do with their final balance sheet. So even though they're not shrinking it anymore, what's its composition like? So there's talk that the Fed wants to have a treasury-only portfolio. Right now, a lot of it is about $2 trillion is in MBS. And there's also talk that they want to hold more treasury bills and fewer coupons. Now, this matters a lot because, as Johnny mentioned earlier, so the long end hasn't traded well, but part of it is weaker demand from pension funds and so forth. But in the past, I've noticed that whenever the long end is not doing well, we have news that maybe Treasury will issue less. And we saw that in Japan, right? The Ministry of Finance issued fewer longer dated JGBs, and that helped the market a lot. Like Jim mentioned, there's a lot of things the authorities can do to try to manipulate the supply and demand of treasuries. And what the Fed officials are talking about right now, and this isn't finalized, we've only heard from a few people, this is something we'll hear in the coming meetings, is they might hold a portfolio that has much shorter duration than they have now, and that would increase the supply of treasuries, upward pressure on rates. And one of the more hawkish members actually wants to sell MBS outright. So one thing I'll note is that the people who are actually the super hawks on the balance sheet are actually Trump appointees, and these are also guys that have been clamoring for rate cuts. And so in thinking about whether or not the executive would take over the central bank, I think in time they will. But so far, I think that the Trump appointees have been saying things to make President Trump happy, rate cuts, but on the other hand, are talking pretty hawkish on the balance sheet. So that tells me that it's not a Trump Fed just yet. It could be in the coming months, but today it isn't.
Thank you, Joseph. A really good in-depth overview there. And I'll be the first to admit, a lot of the market things, a lot of the macro, I can't fully grasp. And so it's really nice to have these breakdowns and even the occasional disagreements that happen. It's perfect for me. This has been a really good panel so far. We've got about 3 minutes until we get some data, and we'll take our normal little few minute pause while the panelists kind of look things over on that. But leading into it, and if we have to pause in the middle of the question, that's perfectly fine. Don't worry about it. We got time to come right back to it. I want to take a look quick at yields a little bit. So we noted last time that classic 2-year to 10-year inversion is partially reversed at this point. Although that's true, real yields do remain pretty elevated, and the term premium is near multi-year highs at this point. Does this signal renewed market optimism about growth? Or is it, as one of the other panelists said earlier in the panel, just concerned that inflation will stay higher for longer? Last Bear, then Johnny. Do you want to take a look at that one?
Yeah, I mean, I think a lot of people have talked about the yield curve. I think it hasn't really reacted. It hasn't provided as much of a signal as it seemed to have reliably over prior cycles. I've pointed this out, I think, when we've talked about it before, but I would just note that the tools of monetary policy have changed pretty substantially, even in the past, let's say, 15 years. That might make that less of a reliable signal, both with the level of intervention, direct intervention, in terms, and in the form of sort of large scale asset purchases, i.e., QE or QT, as well as sort of forward guidance. That's really explicitly meant to be sort of a soft form of yield curve control. So, messaging to the long end what the Fed's expectation is over, not just tomorrow, but the coming years ahead, which should have an influence over, how that 2-year trades in particular. So I just think that there's a lot of noise, and I think it's tough to draw too much of a firm opinion on it. I think if that has been your reliable sort of indicator, it probably hasn't worked out too well so far this cycle. So I just remain a little bit cautious about it. Not to say that it's not something that might sort of work out as a signal at some point, but just that the tools of monetary policy really are different today than they were in prior cycles.
I would agree 100%. First of all, when the yield curve inverted originally back in whenever it was, there was all this talk, I guess it was 22 when the Fed was hiking. There was all this talk about it's a surefire signal of a recession. That certainly didn't happen. Now we're in the reverse situation where the Fed is cutting. Oh, wow. Now we've got some Jeff Schmidt dissented in favor of no rate cut. The Fed's going to stop shrinking its balance sheet. Joe's quite right about that. And Miran dissented in favor of a 0.5-point cut. Anyway, getting back to what I was saying, there was this fear that if the Fed is cutting aggressively while inflation is still hanging around 3%, the long end of the curve could sell off and you'd have a much steeper yield curve. Well, that also hasn't really happened. It's been stuck at around 50 basis points, the 2-10 spread, for a year and a half now. And it just seems that the ultra long end of the curve and the 10-year point, right now, the 10-year point is kind of anchored to 4%. And so the long end of the curve has behaved quite well. It doesn't seem like concerns over inflation have really affected it as much as many people would have expected.
Thank you, Johnny Last Bear. All right, it looks like we've got a little tickle of information here now. Looks like the 25 bips is on the table. Like I said, we'll let the panelists look things over a little bit here. They will say much more intelligent and interesting things than I will glancing over things. So bear with us for a moment while we take it in. Now, I know that there are a lot of abbreviations, and so while we're kind of glancing things over, anybody who's looking at the note, there are a lot of terms like FF rate, IORB, SRF, on RRP, discount window. While we're kind of looking through some stuff to harp on here, would anybody care to just kind of differentiate what some of that stuff means for the audience? And I'm also curious about the two dissents Johnny mentioned. Is there any kind of are we looking at any kind of infighting via these two dissents? And in the last one, we also had dissension to the rate cut.
Yes,
Well, I
I think if
think.
I go ahead.
Oh yeah, I was just going to say, it's like I said before, it's a very divided committee here. We have a couple of hawks, Jeff Schmid and Alberto Musalem, if I've pronounced his name correctly, and then you got the doves, Bowman Waller, and the uber dove Miran. So it's quite a divided committee, but two dissents is quite something. It's probably going to get worse.
There's also a balance sheet decrease of $5 billion in treasuries and $35 billion in MBS. Joseph, are we looking at, back on that topic of culling the QT, are we seeing evidence of that here today?
So what they announced was the end of QT, but not today, to be effective in, I believe, December. So like some analysts have suggested, the Fed is concerned that they might be overdoing QT, and so they're going to stop the balance sheet shrinkage. Now, the two things going forward is to see whether or not they will have to re-expand their balance sheet by buying treasury bills, because interest rates continue to have upward pressure, the repo rates are. And the most important thing to look forward for today, from my perspective, is if there's any further discussion on the ultimate composition of the Fed's balance sheet. Are they really going to have more bills, fewer coupons, which of course increases the supply of duration, upward pressure on interest rates, and of course, whether or not they're going to sell MBS, which would really upset the president and be bad and put upward pressure on mortgage rates. And also, one thing to note about the dissent is this guy is a Fed president and he is a hawk. And Governor Moran, of course, is the president's man there. So there was some fear that next year, because the Reserve Bank presidents would be up for reappointment earlier next year, if there was a Trump Fed board, that they could have significant influence over whether or not they reappoint these Fed presidents, and so this dissenting Fed president could be out of a job. But so far, because of the court case that is preventing Governor Cook from being replaced, so far it doesn't seem like they have the power to significantly reshape the FOMC by controlling who is appointed a Fed president. So Fed presidents don't have to be nominated and confirmed by Congress. It's a much lower standard.
I'll jump in. Has the dual mandate risk, they flipped at all? I don't know what you guys think. They seem to be more focused on employment than inflation risks. Did you pick up on that, or what are your guys' thoughts?
Yeah, they've always been like that. That's kind of why we have 3% inflation, and looks like we'll have that for the foreseeable future. I think it's just part of the culture and politics of the moment. I mean, if you look at what President Biden, when he nominated Fed board governors, he nominated a whole bunch of people that weren't really good at macro, but had strong backgrounds in labor. And it looks like that's still going to be the case today.
All right. Does anyone have anything to add to those points before I rope us back in? All right. So I'm going to take us back. We were last discussing the 2 to 10 year inversion. And the last point we were kind of tickling there was about a signal of renewed market optimism and growth, or just concern about inflation staying higher for longer. The follow-up I wanted to tag on here, and I hate to throw this caveat into the fray, is market optimism as a whole, just in equities, seems to be founded mostly in the boom generated by Nvidia and other powerhouses in the AI discussion. I'm just curious how people feel about that. Is this just unwarranted optimism? I know one thing that comes up in discussion a lot would be like OpenAI. They've got a lot of contracts. I think it's like $1.5 trillion worth of deals between other companies with the government. And from what a lot of criticisms toward that is that there's not a whole lot to show there, and there's this constant discussion about a bubble. Is it a bubble? Is the market way too optimistic here, or are dissidents to the AI explosion wrong? Anyone, feel free to jump on that. I know it's a pretty loaded one.
I'll jump in. It feels a lot like 97, 98, in my opinion. I think it's got some legs. You've got the Fed having no choice but to shift to easing, and the market's embracing that and redeploying it to high. This goes back to I put a post on Twitter. I think U.S. yields are telling you it's more worried about a debasement trade than anything else, and having that asset inflation and that liquidity finding its way to a small component of the economy that is driving all of the growth. AI is real; it's there. There's trillions of dollars being about to be spent. There was a big announcement by Brookfield, Canadian company that moved to New York, with $100 billion in 80 to 100 billion to build nuclear facilities to fuel these data centers. So there's a lot of we're still in the throes of it. So there's a lot of incestuousness in regards to vendor financing among Nvidia and everybody else. And how's it going to end? Is it going to end in a bubble? Probably. But I think we've got a lot of juice here, and it's going to take some time for this continues to play out. In the end, I'm a little more pessimist. I think this reminds me a lot of what happened in China when they built out these empty cities, and there was a lot of economic benefits from China, and that drove energy prices. And I'm seeing a similarity with data centers. I think we'll get efficiencies, and maybe we'll be knocking down data centers in 10 years or 5 or 10 years when they've been overbuilt.
I want to give a shout out to Martin and Johnny here. Last time we were asked this question, I thought we were, I still do think we're in a bubble, but Martin was quite positive on the market, and Johnny wisely counseled to not get in this way. And here we are today, making new all-time highs basically every single day. So great cause for both of them.
Well, when you got money in the market, you gotta participate with it, but you gotta be careful about the drawdowns. But there's just so much flow and liquidity. I think people really need to get an understanding of liquidity and how it influences the market, because there are segments of the market. We talked about auto loans, talked about private credit. There are segments of the market that's a dog's breakfast out there, and you don't want to own that for your clients as a portfolio manager. Otherwise, you won't be a portfolio manager. And all that money, like in Canada, I'll talk a little bit about Canada here, but foreign investors, Canada, we've been, despite the TSX, actually the Canadian market did better than the US market this year. Hee-haw. You can thank gold producers for that, because we although the Bank of Canada and Canada doesn't own any gold, we do have miners, so that's been beneficial to the TSX. But on the flip side, everybody's moving capital flows, 84 billion of net capital outflows from February to May into the U.S. and foreign securities, mostly U.S. And foreign investors are moving money out of Canada into the U.S. and it's going into those tech stocks. So there's a big vacuum there, and it's sucking up capital away from other countries and other segments into that one area, and that's a lot of momentum that you don't want to be short.
Yeah, I agree. The other thing that that's worth pointing out is that the rally that we had during 2023 and 2024 was purely driven by an expansion in the PE ratio as far as the S&P 500 is concerned. It was purely expanding PE ratios, and earnings growth was pretty non-existent. In the last 3 quarters, we've had very, very strong earnings growth, earnings per share growth, which has driven the rally in the S&P, and it's going to be the same in the current quarter. I think year over year, the S&P is up about 16% or so. Something like 12 of those percentage points is EPS growth, and the rest is a slight expansion in the PE ratio, something like that. But this is not just like the blow off top that we saw in 1999, where PE ratios just went to the moon. This is actually grounded in solid earnings growth. But I do agree that eventually it'll end in tears. I mean, it always does when things get crazy like this. But right now, what we've got is a lot of these big companies. They are pouring tons and tons of money into AI infrastructure and development because they're frightened of losing out in a competitive battle with everyone else who's doing it. And I think it is a little bit similar to the midway through the internet bubble. And if you think back, we had all these different internet explorers. There was, well, kind of showing my age here, but Netscape and all these other ones that just fell by the wayside. And there's only one now, that's Google. So I think a lot of these companies that are pouring loads and loads of money into AI, they just feel like they've got no choice, because otherwise they're going to be the ones that fall by the wayside.
Man, Netscape brings me back. I just remember being like 5 or 6 at my grandma's house, and you had to boot Netscape off a freaking CD.
Yeah, on a dial-up connection. Yeah.
So oh, go ahead.
I was just gonna hop in. I mean, I do think that one thing that you can look at is just like where, if you're trying to figure out, okay, everyone kind of agrees maybe there's going to be an overbuild. When's it going to happen? You got to look at like where's the money coming from? So like as it transitions from purely being hyperscaler operating cash flow, which it really was for let's say a year or two, to branching out where Microsoft takes a little bit of a step back, and then a second tier hyperscaler Oracle comes in and picks up the thing, and then you're going out to SoftBank, and you're going out to the Saudis, and then Meta's now going with Blue Owl to fund their thing, and Oracle's raising debt. Like, you're moving out sort of the pockets of financing from being sort of totally riskless to being more and more debt focused, is a progression of that sort of process. And so the question is, when does the money run out? And at that point, I think is whether it's funding for someone like an OpenAI to be able to fund, be able to operate at such negative cash flows as they grow share and try to take over. That can happen as long as as those sort of funding channels are open. So we've seen it sort of move out along the risk curve, from the most reliable to less stable structures, and I think that'll be the thing to watch.
So I'm just curious, like not to harp on it for too long, but kind of tying in our discussion on inflation as a whole at the top of the show here, combining that with what seems to be pretty euphoric buying in equities, as Joseph noted, it seems like every single day we're getting a new all-time high across the board. Gold has been doing crazy shit this year, for lack of a better word. Are U.S. markets underestimating how much foreign policy turbulence could affect inflation in the markets as a whole, or is this just how it is now?
I mean, I guess I would say that there's no way to look at the market and not at least have some sort of flashbacks, at least to 2020, 2021, in terms of zero revenue companies that are going up 800% in a couple months. And it feels like just a chasey FOMO-y market where, yeah, there's probably a lot of fundamental good stuff in it, but as it continues to sort of get into less and less sort of believable or higher out on the risk curve, whatever you want to say, there is a level of froth that I think is that, that few people would deny. And I think that you can also look at things like the level of leverage in the market, whether that's sort of the old school margin leverage, kind of statistics, or whether that's the amount of call options buying that's happening, which is now, exploded again to new record highs over the past month or two, as you've seen these, really speculative type names just go through the roof. And so it's just, to me, it's sort of a signal on where the broad market sentiment is. And even if we saw a little bit of this back, I would say starting November or so of last year, and then that kind of led to at least a short-term correction that was pretty significant. I would say in the first quarter of this year, leading into Liberation Day and whatnot. So even though the economy didn't collapse, there wasn't a recession, there still was a significant sort of rebound from a euphoric sentiment in the market. And so that is something that I think you need to be aware of.
Well, I also add that, what we see in the US, we see it everywhere in the world. Look at the Nikkei, look at the FTSE, look at Euro stocks, right? Everything is going to the moon. So this euphoric sentiment that the last pair mentioned, it's something that's everywhere. And maybe it really is just a whole bunch of people buying calls. And after all, that's worked really well.
I think we're ignoring the elephant in the room, gold and silver. It's telling you a lot, and everyone's trying to figure it out. And there's all kinds of different explanations. The one I'm leaning towards is more of the debasement, the Fed losing control in regards to the U.S. government that's spending like it's a financial crisis, and that's not being curtailed. And it's not just, if you go talk to Joseph, it's not just the U.S. Hey, we're getting our budget this week. We're talking like for Canada, this is massive, the biggest we've had since COVID. It's like $100 billion, and it's not just Canada. It's everywhere else. France has had its debt downgraded. Canada, it's got the second worst household debt in G7. It's terrible. When you include, everyone's looking at Canada's federal debt, saying it's okay, it's much better than the U.S. But when you include provincial debt, which you should, we're terrible. We're worse than the U.S. And the only component that hasn't increased is our federal debt, and that's ballooning out, and that's going to have consequences. So I think the global trend is reckless fiscal spending, and that's debasing currencies, debasing and inflating. People saying, okay, I can't be exposed to that, and that's why these markets are moving higher, and in addition to what's happening in the tech space.
I just want to jump in with a couple of points there. I don't disagree. The US deficit and the debt to GDP ratio is going in the wrong direction. But in Europe, there is some pretty good progress among some of the countries. The problem children from the European debt crisis are now very well behaved. Greece, Italy. Italy's deficit this year, deficit to GDP ratio, could drop below 3%, and certainly it's budgeted to drop below 3% next year. I mean, that's an incredible achievement. So they're doing really well. Spain is also in pretty good shape. Here in the UK, we're not in great shape, but we're about to get some pretty more hefty tax rises to try and correct things. But the US, hasn't really done much so far to get the deficit under control. But one way to fix that problem is to maintain very high nominal growth, and then your debt to GDP problem kind of gets inflated away. And to some extent, that's the strategy, or it seems to be.
That was absolutely beautiful. I love the constant in referencing between hosts, the mutual respect, the eagerness to learn on these panels. It just goes to show that everybody's learning about this stuff all the time. And the panelists that we have on here, you guys are so friggin' smart, and you still show this eagerness to get another point of view, to get more in-depth explanations on something you're not hot on. And I know a lot of you see the Twitter landscape. That's just so rare. lately, it seems. And so I am just basking in this. Thank you guys so much. I want to touch one more market related thing, and I'm kicking myself in the ass for not doing it with Jem here. I know he tends to have to go off and do something else around that 2 p.m. mark. So this is my fault for not doing this while he was here. But I want to take a quick aside before we get to Jay Powell's presser about liquidity conditions and margin debt still looking pretty elevated relative to prior cycles. And I'm wondering if volatility spikes from these levels, could we see financial stability concerns outweigh inflation progress in shaping the Fed's tone? I guess a little more specifically, at what threshold in the VIX or funding spreads would policymakers shift their tone in the presser? Joseph, your thoughts?
So I think you make a really good observation that there's an enormous amount of leverage in the market. We've all seen those charts of margin debt. Something else to keep in mind is that a lot of people have been expressing leverage through options, and options volumes are soaring. And there are also charts showing that retail options buying is at historically very, very elevated. So that does create fragility. So I think if we do have a big correction in the market, another way to think about that is, a lot of wealth, a lot of dollar value just kind of evaporates. And so when you think of debasement in the sense that, yes, the government is printing a lot of treasuries and so forth, a lot of value, a lot of fiat value that we have is just tradable stuff like equity markets value, and that can go poof. And so when that happens, and it looks like, when you go straight up, oftentimes you correct violently down. When that happens, maybe inflation just won't be a problem anymore. Maybe we'll go back to worrying about prices too low, at least temporarily. I don't really think that, so we've seen a lot of commentary from the Fed and also their financial stability report suggesting that equity values are historically quite high. So I think it'd probably take a notable wobble for them to actually be concerned about anything, because prices are so high right now.
If I can just add on to that, I think one interesting dynamic that we kind of touched on earlier is whether you have sort of this monetary plumbing question and how does that tie into the rest of the system. So, like, for example, we talked about repo rates kind of spiking, some increased use of the Fed's primary credit or discount window, and whether or not, if you had a situation where there was some sort of intervention, so to speak, into these sort of monetary markets. I think that the way that the Fed would say that and how they've kind of talked about that side of monetary policy is that it's not supposed to be, those balance sheet decisions, tweaks around the edge are not supposed to be indicators of of their broader stance, and hence the famous not QE, asset purchases kind of concept. But if they were to come in, what would the broader market take away from that, regardless of what the Fed's sort of, how they want to explain it? Would it be perceived as liquidity positive and accommodative? And could that, how does the market take that? So I think that there is, because there's so much leverage, you kind of have a little bit of instability at the base. And if would they intervene in the case that you have a 20 basis point spike in repo rates? Probably, yes. I think that they would. Now, would that be taken as a signal for the market that the Fed is for sure going to have your back at every single bump along the road? Also, probably yes. So it's that's kind of a dynamic that I'll be looking at.
Household debt in the U.S. is only like 68% of GDP. It's like well over 100 in Canada. So people in the U.S., the boomers are booming. They have money and they're spending it, and they're doing YOLO spending, and that's going to continue to drive services inflation. I know a lot of people that have moved down to Florida from Canada, and with their businesses and servicing into the services sector, health and lifestyle, exactly. And it's just on fire. It's incredible to see. And if you look at equities, I think the average is 40 to 50% of their net worth. And so equities keep pushing higher. Liquidities is available out there. Household debt's low. And this is a smaller percentage of the overall population. And we're going to see a widening of the wealth gap continuing, and that's going to create a whole bunch of different challenges, in my opinion, around polarization. You look at what's happening in New York City with its mayor, and that's making international headlines, and people moving to the other extreme and creating instability. But having said, answering your question, there's a lot of room for these things to continue to move higher.
Yeah, I just want to say a couple of things in support of that. If you look at household debt in the US, or household leverage, however you measure it, whether it's financial obligations, the amount of interest they've got to pay each month as a proportion of their income, it's super low. The household sector has really, really massively deleveraged over the last 15 years. Same for the corporate sector. If you look at corporate interest payments as a percentage of profits, it's at a multi-decade low. So it's the household and the corporate sector have both massively deleveraged. The leverage has moved to the government sector. It's the government that's over leveraged these days. So it's I just think if we do have a liquidity event, it's going to be very, very different to what we saw in the past. Whatever happens will be completely different, and it'll probably come from a source that no one was really expecting.
And Johnny, I think you had mentioned what's really interesting is that taxation. You mentioned Italy doing really well. They've done some major tax changes to attract people to move to Italy. I wish I could if the time change worked, because I was out there in spring. It was freaking awesome. But I'm had to lose. I'll be 250 pounds if I lived there. But tax changes are important. And if you look at in the UK, there's been, I think I read like 16,500 millionaires have left or in the process of leaving.
Yeah.
And they're going to go and bring their capital with them to jurisdictions that want them, and those jurisdictions are going to benefit from it. In Canada, there's no room to increase taxes, and our tax, like for example, I threw this number out last time. This will shock you. The average income required to buy a home in Canada is $210,000. This in Toronto, Vancouver, the biggest cities. We consider you to be ultra rich, the richest of rich, and you get taxed at the highest tax rate, over 50% combined provincially and federally, at $240,000. So you're 20,000 shy of being taxed at the highest level, and that's the lowest level you need to buy a home. Canada is, pardon my language, fucked when it comes to that. If you look at the U.S. and other jurisdictions, there's a lot of room on taxation, and households are in a much better position from a leverage standpoint. So those jurisdictions are going to continue to outperform.
That's interesting. I thought we were in a mess here, but I feel better now. Thanks.
Guys, we have a golden visa program, just so you guys know.
You got room for me in your basement? You got room for me and my family in your basement?
I was going to say, if those millionaires really need somewhere for that money to go, I got a couple of bank account numbers I can shoot over to them right quick. We can get this figured out in a few minutes. So speaking of few minutes, J Powell's presser is starting here in a few seconds. But before I flip our audio over to that and the video on the Unusual Whales YouTube channel, real quick, I've got 4 of our panelists left here. If you guys got something to plug, please plug the shit out of it. Where can people find you? Where can they go to learn more about what you do and what you got going on? Let's start off with Joseph and run right down the line.
Well, first off, thanks so much for having me. It's great being on this panel. If you guys are interested in hearing my thoughts on the FOMC, I'll post a video on my channel on YouTube, Joseph Wang. All right, talk to you guys next time.
Hit me with some spice, last bear.
Yeah, follow me here on Twitter, and if you want to check out my Substack, please do. You can find the link in my bio.
Martin.
Hey, thanks for having me. Looking forward to some snow and some powder. If anybody ever wants to come and do some skiing, you know how to look me up. I'm the crazy Canuck up here. You got me on Twitter. Thanks so much for having me. It's such an honor to be among such awesome dudes that on this panel.
Thank you for having me on the show. It's been a real pleasure, especially with such great guests on the panel. If you want to follow me, take a look at my website, www.super-macro.com, or find me on Twitter, super_macro, super macro.
Beautiful. Everybody listening today, do that. If you're not following these guys, what the hell are you even doing? Why are you even on Twitter? Follow them. They have so much information and stuff to teach. You're really missing out if you're at all interested in the markets, especially the macro view. Follow these folks, everybody. Give me about 10 seconds here, guys. I'm going to get the audio flipped over to Jay Powell. He's talking right now. Feel free to hang out if you'd like. The video itself will be on the Unusual Whales YouTube as well. Give me just a minute, folks.
Sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the year. In the labor market, the unemployment rate remained relatively low through August due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because, you know, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, you know, that would certainly play into our decisions going forward. So, we do have, you know, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get, you know, job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and, you know, the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, you know, we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the, the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's, I guess, 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the 3 components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we'll expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspective is of people on the committee that, we've now moved 150 basis points and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, you know, I've told you the story. It's a complicated story, but this is the best assessment that we can make. But you know, because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, you know, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and you know so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and you know it looks like they have business models and profits and that kind of thing. So it's really a different thing. You know, the investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, you know, is much bigger than that and has been growing and has defied a lot of, you know, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, you know, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. You know, the economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But you know, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. You know, it'll probably be argued both ways, right? But I've said a couple times here that, you know, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, you know, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you know, you slow down when you can't see as far ahead. Others may argue, I mean, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, you know. So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, you know, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, there's no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France-Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so it's a challenging thing, and, as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, everybody, that concludes this month's FOMC panel. If y'all didn't follow the panelists, like I said before we started the J. Powell presser, I'm going to be very cross with you. Everybody, follow those folks. You're going to learn a lot. I learn a lot on every single one of these. Sorry, I muted my mic there. Nonetheless, we are done with today's panel. Just be on the lookout on the Unusual Whales Twitter page for any upcoming panels. As a little secret, we've got an options trading show coming up in mid-November. So be on the lookout for that. It'll be on YouTube and it will be live. So just be paying attention to the Unusual Whales feed for any upcoming events, panels, interviews, news. And thank you all for spending a good brunt of your afternoon with us today. I hope you guys send yourselves off into the afternoon feeling chipper and excited, and have a great rest of your week. Thanks for hanging out with us, folks. We'll catch you in the next one.